Well, it's too soon to say that the Federal Reserve has turned dovish. As expected, the Federal Reserve had to stay hawkish, but they gave us some hints of how things could potentially turn dovish that we weren't expecting, which initially led stocks to rally a bit, but that was quickly put to bed, especially as Jerome Powell told us that the path to a soft landing has narrowed. The window is shutting, specifically because we expect to stay at higher rates for longer. Jerome Powell made it very clear that if today we were going to do a summary of economic projections, which we last did in September, we would once again, which has been consistent for the past year, revise our expectations up. Keep in mind the summary of economic projections has a terminal Fed funds rate projection of 4.6% before you turning down. Now, Jerome Powell is suggesting that would go higher. How much higher, we could really only determine based on some of the things that we've heard from Nikki Leakes over at the Wall Street Journal, whom over the last few days suggested that the Federal Reserve sees the potential for a terminal Fed funds rate between 5.25% to 5.5%. And of course, as inflation continues to be more broad and persistent, we get a more restrictive path that is necessary. We did get some answers to big questions that we had, like, is the Fed just totally blind to the fact that if you subtracted shelter inflation from CPI, we would be at 0% inflation? Jerome Powell actually gave us an answer. Unfortunately, it wasn't the answer we wanted. It was an answer that just plays into the Great Reset playbook that the Federal Reserve is just here to ream us. And the answer was, yeah, we know you could take out shelter inflation and basically recognize that inflation is zero and that some of the recent leases signed on the margin, so the recent ones, are suggesting that rental rates are coming down, but they're coming down from a level that's actually higher than where CPI is even recognizing that inflation is. In other words, suggesting we actually have more up to do before we go down. This is actually consistent with what JP Morgan suggested, that shelter inflation would probably remain at a month-over-month rate of somewhere around 0.7 to 0.8% for another year, which is really bad because that suggests somewhere between 8.4 to 9.6% inflation from a segment of a CPI report that eats up like 32% of CPI and somewhere around 20 to 25% of PCE. And so while Jerome Powell said we're well aware of that, unfortunately, he's also well aware that rents overall are still trending up, and even though on the margin they've trended down, we still have more pain coming, so he's focused on that overall CPI picture. This led markets to be, understandably, a little bit sad and questioning the Federal Reserve's path, especially when they talk about this idea of, hey, I thought y'all were gonna slow down, which should not be considered a pause. Jerome Powell said at least 3 times that it is way too premature to talk about a pause. A pause means no longer raising rates. Instead, Jerome Powell talked about 3 steps and 3 core questions. How fast should interest rates be raised? And he suggested, look, we've got to move into a more restrictive territory. And he fumbled a little bit on one question when we said, as we move into restrictive territory, and then kind of corrected himself and said, as we continue to raise rates, suggesting he realizes we're in a restrictive territory, but ended up saying, even though we're in a restrictive territory, we still need to keep hiking. Now, we might hike at a slower pace. The CPI data that comes out over the next 2 reports between this Fed meeting and the next Fed meeting could lead us to slow our pace of rate hikes in December to 50 basis points, or in the meeting after this December. Again, depending on reports. Jerome Powell said the slowdown may come within the next 2 meetings and as soon as the next meeting. However, that's not to be confused with the fact that they could actually just keep hiking rates at just smaller increments. For example, if we go from 3.75 to 4.25 with a 50 basis point hike next, but then we go 25, 25, 25, 25, 25, we could be at 5.5 or 6%, even with 25 basis point hikes. And so that's the second question, is how high do we go? And all Jerome Powell gave us here is we still have ground to cover. In other words, we still have rates to hike. So sure, the individual meeting to meeting hikes might be a little slower starting in December. But what really matters is not how fast we're hiking them anymore. What actually matters more is where we end up which could be higher and would be higher if we had to decide today than what we previously expected. On top of that, and this is still to be determined, is how long do we actually stay at those higher, more restrictive rates? Now, markets, of course, were very, very enthusiastic when we got this blue text added to the policy statement, which suggested that in determining the pace of the future increases for the target rate, the committee will look into and account for the cumulative tightening of monetary policy and the lags at which monetary policy works. As this statement first came out, I talked about something that Jerome Powell also ended up talking about. And that's that the first thing that happens is the Federal Reserve tightens rates, or markets anticipate the Federal Reserve tightening rates. Then you see economic activity slow down, which generally starts with businesses. Business fixed investment coming down, as Jerome Powell told us in today's meeting. You also start seeing interest-sensitive sectors like housing slow down, and also, again, business investment, because businesses that are investing tend to utilize rates that are based on things like the Wall Street prime rate, the SOFR rate, the LIBOR rate. These are all rates that move right with the Fed funds rate. Jerome Powell made it clear that consumers usually don't borrow at this rate, so there can be a lag in when consumers react. And then only after the Fed acts, financial conditions tightening, business economic activity tightens, and consumer activity tightens, then we start seeing inflation come down. And so we have no clear charted path as to how long it's going to take, but he does recognize that there are lags. Now, while that lag talk was really enthusiastic or created a lot of enthusiasm for markets, Jerome Powell kind of ruined it really quickly, because he essentially told us, look, if we over tighten, we could just turn the money printer on again. This was not what markets wanted to hear. Markets didn't want to hear, yay, worst case scenario, if we over tighten, we'll just turn the money printer on. So markets saw something that kind of looked dovish, but then got really sad because they realized Jerome Powell would rather over tighten and then stimulate than not tighten enough and lose control of inflation and have inflation become entrenched. Unfortunately, that's bad news for the stock market, which means stocks down, and bad news for bonds, which means bonds down and yields up. Because what you're saying here is Jerome Powell in today's meeting tells us, hey, I don't think we've over-tightened yet, but we would rather over-tighten than under-tighten. So in other words, we still haven't done, the real damage, and we can keep going, and we would rather keep going than pause too early. This is why I made it very, very clear that we are not expecting a pause anytime soon. Maybe we'll expect a slowdown in how quickly we move interest rates up. Regarding a wage spiral, Jerome Powell says we don't see a wage spiral right now. However, once you see it, it's already too late. You're in trouble. So that was not exactly what we wanted to hear. However, there was something slightly bullish in that, hey, Jerome Powell thinks we can actually end up seeing the jobs market cool just by having opens come down, job openings come down, without actually seeing unemployment go up. Personally, I think that's bullcrap. Personally, I think you need to see unemployment come up. And I think that's more of a political statement that basically says, yeah, we could do this without causing joblessness. Yeah, right. Like I said before the meeting, and on Twitter, follow me there at RealMeKevin. I said it both before the meeting and on Twitter. Before the meeting. Mom and Dad don't skip out on travel and a steak dinner because Jay Powell raised rates. But they do skip out on travel and a steak dinner when they lose their jobs. That's when consumers get affected. And that's the kind of lag that we're waiting to actually take hold of markets, but we just haven't seen it yet, especially since consumer spending is still growing and household spending might even be offsetting government spending that we previously had. Something Jerome Powell talked about, the shift of fiscal spending to household spending because household balance sheets are so strong. He does suggest that, or re-suggest the importance of the housing market coming back into balance. This is an area that he believes is very overheated and has been very overheated, and that there's still more work to be done in the housing market. Remember that Jerome Powell was the one who told us, hey, if you're a first-time home buyer, I might wait for more of a reset in the housing market before buying. And this is something I've been talking to all the course members about in the real estate investing course when we do deal analysis and we look at comparable sales and investment opportunities. Say, you know what? Just probably not the best time yet, but stay tuned. Same is true for House Hack. We're waiting. But anyway, balance sheet is still being reduced. Not too much insight into the balance sheet. Are concerned about inflation break-evens starting to trend a little bit higher. This is a big concern actually, is the potential for inflation break-evens to move even higher than where we've been used to. If you could see this chart here over the last year, we've started to see inflation break-evens move up again on the right side. That's not the direction that we want to go in. And when asked about the inversion of the 3-month real bond yield curve, we are close to it, but not there yet. However, once we see that inversion, we tend to confirm a recession, as you can see depicted graphically here. So basically, Jerome Powell tells us, yeah, look, there are lags in the economy, and it takes time to bring inflation down, but we're in an unprecedented time, and we'd rather hike more than do too little. So in other words, keep shorting, sell your stocks, get out of margin because he's about to get hosed, and enjoy as we continue to tighten rates more at the Federal Reserve for longer. Again, remember, you could be at 3.75, and I just want you to think for a moment about how this could go, because there's no this whole like pause talk is nonsense. There's no pause yet, right? What we really want to pay attention to is the following. Take a look on screen now. You go from where we sit now, 3.75%, and just go to 4.25% with a 50 basis point hike. Watch, we do another 50 basis point hike, and then you just go 25s, right? Then you could be at 5%. So let's say this could be December right here. Let me get the full calendar, and I can give you actual dates as well. Fed FOMC meeting calendar. So this right here would be November 2, 2022. Then we've got December is next. And, oh, that is the wrong calendar. Come on, Kevin. Fed. Hey, here we go. December 14th. December 14th, we could be at 4.25. January 27th, right before my birthday, 2023, we could be here. And this would be a 75, 50, 50, 25, right? You could see something like this. This would be March 17, 2023. Then you could see April 28, 2023, again another 25, right? You could see this continued hiking for quite a while. And so this idea that, oh, the Fed's ready to reduce rates, not necessary. June 16, July 28, 2023, right? I mean, look at how long this could keep going. You could be at 5.5% right here. You could be at 5.75% right here. And quite frankly, by September of next year, 22nd, 23, you could be at a 6% Fed funds rate. Entirely possible. Now, we don't want to go to those levels, but even with 25s, you could get to 6% before September. That's scary. You know, if now you start moving at 50 basis point hikes, it moves even faster. But it shows you, like, now we're not so worried about this decline right here. Certainly the market shouldn't be so worried about this move from going from 75 to 50. That's not where we go bullish. Where we go bullish is, in my opinion, when we start seeing something like this, where we go, oh, we're going to cut rates by negative 25. But how much time is between hikes and cuts? And that is all a big old question mark. But something that'll never be a question mark is your opportunity to get life insurance in as little as 5 minutes by going to metkevin.com/life. Using that Halloween coupon code, we're changing the pricing this afternoon to November pricing, so slide in if you still can, if that coupon still works. And of course, get yourself 12 free stocks with Webull by going to metkevin.com/Webull. Thanks so much for being here. We'll see you in the next one. Good luck.